All right, so today we're diving into something I know you've been curious about.
Okay.
Using art as an investment.
Oh, cool.
You sent over this blog post from Quantpedia. It's called Portfolio Diversification, including art as an alternative asset.
Mm-hmm.
And it really breaks down some academic research on whether art can actually be a smart addition to an investment portfolio.
Interesting.
Now, most people, when they think about art, they think about it as a passion, as something beautiful to enjoy, not necessarily a way to make money.
Right.
But could we be missing out on something here?
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
It's a fascinating question, isn't it?
Yeah.
We often separate those worlds, art as passion investments, as purely financial.
Right.
But what if there's a way to bridge them?
I like that.
Yeah.
And I think this blog does a fantastic job of summarizing some of the key findings from the paper without getting too lost in the academic jargon.
Yeah.
And it starts by highlighting that art returns, while definitely up and down, don't really move in the same direction as traditional assets like stocks and bonds, real estate, gold.
That low correlation is what makes art so intriguing for diversification. Think of it this way. When the stock market takes a tumble, your art holdings might not be affected in the same way.
Right.
Potentially even holding their value or going up.
Oh, wow.
Yeah, it's like having a backup parachute just in case.
Interesting. That makes sense. And the blog even says that art may be a better safe haven than gold during economic crises. That really caught my eye.
Yeah.
But I got to admit, when the blog started talking about efficient portfolios,
Okay.
my brain started to fog up a little.
Oh, no worries. That's a common reaction. Efficient portfolios sounds intimidating.
It does?
It's a really powerful concept.
Okay.
Basically, it's about building a portfolio that gives you the best possible return for the level of risk you're comfortable with.
And what this research suggests is that adding art to the mix can actually help you create a more efficient portfolio.
So it's not just about randomly buying art. There's an actual strategy involved.
Exactly. It's about understanding how art fits within the overall puzzle of your investments.
Okay.
Now, one thing the blog emphasizes is that this research focused on the high-end art market. We're talking about the Picassos and Warhols of the world.
Got it.
Not necessarily the painting you picked up at a local craft fair.
And the blog is careful to mention a key limitation of the research.
Yes.
It uses these art indices that aren't actually tradable.
Yes.
What does that mean for someone actually thinking about investing in art?
Well, unlike buying an index fund that tracks the stock market, you can't just buy a basket of art that mirrors these indices. You'd have to pick and choose individual pieces, which requires expertise and comes with its own set of risks.
Yeah.
You're essentially becoming your own curator. So it's more hands-on than just clicking a button on a trading app.
Absolutely. And that brings us to another crucial point that both the blog post A&D, the original paper highlight transaction costs, the art world has a lot of these costs.
Okay.
Buyer's premiums, sellers' commissions, all sorts of fees that can really eat into your profits.
So you're saying that art's potential benefits for diversification have to be weighed against these real-world costs.
Exactly. It's not as simple as just looking at how much a piece might appreciate in value.
Right.
You've got to factor in all these extra expenses.
And then there's the ongoing costs, storage, insurance, maintenance, things you wouldn't necessarily think about with traditional investments.
Right. Those can add up quickly and often surprise people who are new to art as an asset class. It's not like tucking a stock certificate away in a drawer.
So due diligence is key here.
It is.
But I'm still really intrigued by this whole idea of art as a way to diversify my portfolio. The blog mentions how research found art helps create those efficient portfolios, lowering risk for a given return.
Right.
But what does that really mean for someone like me?
Let's make it practical. Imagine you have two portfolios, both aiming for the same level of return. One includes art and one doesn't.
Got it.
The one with art, based on this research, is likely to have less overall risk. That's because art tends to zig when other assets zag, providing a sort of buffer during market fluctuations.
So like a built-in shock absorber for my investments.
That's a great way to put it, creating a smoother ride over the long term.
I like the sound of that. Another detail that really jumped out at me from both sources was this whole seasonality of the art market. They mentioned May and November being peak months. Why is that?
Well, that's largely tied to the auction calendar.
Oh.
Think of it like fashion season. May and November are when the major auction houses like Christie's and Sotheby's hold their big sales. They create this frenzy of activity and often see the highest prices.
So it's all about supply and demand,
Right.
concentrated in those specific months. Does that mean you can actually time the market when it comes to art?
It's tempting to think so.
Yeah.
But remember, we're talking about a complex market with a lot of moving parts.
Right.
While those peaks exist, it's not as simple as just buying in May and selling in November.
Okay, so timing the market might be tricky.
It can be.
Got it. What about this whole art being a better safe haven than gold thing? The blog pulls some really interesting quotes from the research paper, comparing the performance of art stocks, bonds, and gold.
Yes, that was one of the study's most surprising findings. You know, gold has traditionally been seen as the safe haven asset.
Right.
But this research challenges that assumption, at least when it comes to the high-end art market.
The blog mentions this thing called STL decomposition.
Okay.
I have to be honest, I have no idea what that means.
Don't worry, it sounds more intimidating than it really is. Essentially, STL decomposition is a statistical technique that helps isolate the true volatility of art returns from the fluctuations caused by that seasonality we just talked about.
I see.
It's like filtering out the noise to see the real signal.
So it helps you understand how art actually performs.
Yes.
Independent of those predictable ups and downs.
Exactly. It gives a clearer picture. And that picture, according to this research, looks quite positive for art as an investment.
I'm starting to see the bigger picture here. But one last detail before we move on.
Okay.
The paper analyzed semi-annual returns. What does that mean for someone actually thinking about investing in art?
Good question. It suggests that these findings might be more relevant for someone thinking about art as a longer-term investment rather than a quick way to make a buck. Remember those transaction costs we discussed? Jumping in and out of the art market too quickly would probably wipe out any potential gains.
Right, you're starting to get the picture here.
Yeah, it's really about taking a thoughtful and informed approach.
Okay.
Art can be a fascinating and potentially rewarding addition to a portfolio, but it's not a get-rich-quick scheme.
Totally agree. So where do we go from here? What else should we consider?
Well, the blog post, you know, it really emphasizes art as a portfolio diversifier, something we've been digging into. But it also made me wonder, you know, are there certain types of people or specific life situations where art investing makes even more sense?
Okay.
Like, does who you are actually matter when it comes to this kind of investing?
It makes me think about the whole art as passion thing. What if someone genuinely loves art, gets a real kick out of owning it? Could that actually influence their decision to invest?
That's a great point. It's something researchers call psychic return.
Okay.
The enjoyment or satisfaction you get from simply owning something. If you get a thrill out of having a beautiful painting on your wall, that emotional reward could actually balance out some of the financial risks or downsides of art investing.
So it's not just about numbers on a spreadsheet. It's about how you connect with the art itself.
Exactly. It becomes more than just a cold hard investment. And there are practical considerations too. Like if someone's planning for estate transfer, art can be this tangible legacy you pass down through generations.
That's a really powerful way to think about it. It's like adding an emotional dimension to portfolio diversification.
It is.
So we've talked about the potential financial benefits of art, the diversification aspect. Those pesky transaction costs, even the seasonality factor.
Right.
But there's this whole other layer of personal connection and meaning that comes into play.
Absolutely. And the blog post subtly hinted at this. But the research it's based on doesn't really capture that human element.
Right.
It's focused on the financial side. But art is so much more than just numbers. It's about aligning your investments with your personal values, your interests, your passions.
That's such great advice. It's about finding that sweet spot where your personal interests align with your financial goals.
Right. And it's a journey, not a destination.
So as we wrap up our deep dive into art as an alternative asset, what's the single biggest takeaway you'd want our listener to walk away with?
I think it's This art can be a viable and even rewarding part of a diversified portfolio, but it's not a guaranteed path to riches.
Right.
It requires careful consideration, a willingness to learn, and a long-term perspective.
Totally agree. Don't jump in blindly just because a research paper says art can outperform gold. It's about so much more than that.
Right. Remember those limitations we discussed. A study focused on the high-end art market.
Right.
Used those untradeable indices. Didn't account for real-world costs.
Exactly. It's important to keep all those nuances in mind.
It is.
But for someone who's genuinely intrigued by the idea of art as an investment,
Yeah.
what would be your parting advice?
I'd say embrace that curiosity. Immerse yourself in the art world. Connect with your personal tastes. And start exploring what it truly means to own a piece of art.
Great advice. And remember, art should be something you enjoy,
It should.
not just another line item in a spreadsheet.
Well said.
So before we go, I want to leave our listener with a final thought. Both the blog post and the research emphasize art as a portfolio diversifier. But what if we zoom out even further?
Okay.
What if we think about art not just as an individual asset,
Yeah.
but as a reflection of broader cultural and societal trends?
That's a fascinating perspective. Art often acts as a mirror to the times we live in, reflecting social movements, technological advancements, even political climates. And those shifts can definitely influence the art market.
So in a way, understanding those bigger trends could give an art investor a unique advantage.
Potentially, yes. It's like adding another layer of analysis, a macro lens to complement the micro view of individual artists and artworks.
I love that idea. We've opened a whole new door at the end of our deep dive.
And that's the beauty of exploration. There's always more to discover, more connections to make.
Well, on that note, I think we'll wrap things up. And to our listener, keep those questions coming, keep exploring, and keep diving deep.